You are planning to invest or trade stocks, crypto, or ETFs. At first, you have to open a brokerage account and you can place an order online. Here are some basic essential information about order types. First of all, when you look at real-time market quotes, you will see bid price, ask price, and last trade price. Ask price refers to the lowest price at which a seller will sell the stock. If you buy a stock, you are paying that price. That is your buying price. Bid price is the highest price a buyer will pay to buy at any given time. That will be your selling price. The bid price is always lower than the ask price. The difference between the bid price and the ask price is called the spread. Stocks with a wide spread are typically less liquidity than a narrow spread. Wide spread means a stock is not being actively traded and there are small volume of supply and demand and highly volatile. A small or narrow spread means a stock is being actively traded with high volume and greater liquidity. Example: Citibank trading price spread is narrow, only 1 cent difference between bid and ask price because this stock is less volatile and available stock volume in the market is large enough to buy and sell. On the other hand, Climb Global Solutions Inc. has wider spread $1.68 because it has small volume and volatile trading. For day traders who trading multiple trades in a day, small spreads will help them make quick profit. There are different types of orders you can use to buy and sell stocks through a brokerage firm. Some of the order types may not be available through all brokerage firms. The two most common order types are the market order and the limit order. A market order is an order to buy or sell a stock at the market's current best available price. Generally, a market order will be executed immediately. However, executed price will not be guaranteed. A market order typically guaranteed execution, but it does not guarantee a specified price. The last traded price is not necessarily the price at which a market order will be executed. In fast-moving markets, the executed market order price will be often different from the last traded price or real-time quote. The last trade price may not be current. The last trade of low-liquid stocks may have occurred minutes or hours ago. Stock prices can change significantly in a short period of time in fast-moving markets. Therefore, when placing a market order, the current bid and ask prices are generally more significant than the last trade price. A market order is generally appropriate when you think a stock price is right and you want your order to be definitely filled, or when you want an immediate execution. For example, you are looking at a XYZ stock to buy. You will see stock real-time quote, ask price, bid price, and last trade price. Because of you are buying, you are willing to pay ask price that is higher than bid price. Here, ask price is $102.07, bid price $101.83, last traded price was $102.01. These prices will not be guaranteed when your order is executed. If you place a market order to buy 1,000 shares of XYZ stock, 500 shares might be executed at $102.50. The following 500 might be filled at the higher price if stock price goes up. If stock price goes down, your order might be executed at lower than current ask price or last trade price. The same thing goes with selling too. A market order will guarantee immediate execution but not price. Fast-moving market may cause a market order to execute at different prices. Market orders should be placed only during market hours. If you place a market order when markets are closed, that would be executed at the next day market open. That could be significantly higher or lower from prior close price. Between market sessions after hour trading, numerous factors can impact a stock's price, such as earning release, company news, or economic data. Unexpected events that can affect an entire industry, sector, or the market as a whole. You don't want your market order filled with unexpected price. Limit order is an order to buy or sell a stock at a specific price. You set the price you want to buy or sell. A buy limit order can only be executed at the limit price or lower, and a sell limit order can only be executed at the limit price or higher. A limit order is not guaranteed to execute. A limit order can only be filled if the stock price reaches the limit price or better. While limit orders do not guarantee execution, they help ensure that you don't have to pay more than a predetermined price for a stock. Example: you don't want to pay XYZ stock more than $102. You placed a limit order with limit price $102. Since you placed an order, stock price has been up. So your limit order will not be executed. That will only execute if the price of XYZ stock is $102 or lower. There is no assurance of execution. A limit order may be appropriate when you think you can buy at a price lower than or sell at a price higher than the current quote. In addition to market and limit orders, there are following most common special orders. A stop order. Also known as a stop-loss order, is an order to buy or sell a stock once the price of the stock reaches a specified price, also called the stop price. When the stop price is reached, a stop order becomes a market order and will execute at any available current price. In a buy-stop order, a stop price is entered above the current market price while expecting price will go up. The buy-stop order is placed when you anticipate upward movement in share price. If you expect a stock will break out above resistance level, you will put buy-stop order with a stop price little above resistance level, so as soon as the price breaks resistance level, your buy order will be automatically executed and you will own that stocks enjoy nice gains. Also, short sellers must place a buy-stop order because they want to protect big loss if price go up over certain level. Short sellers are traders who sell shares which are borrowed from a broker, expectation that the share price will fall after. If share price does not go as they expected, a buy-stop order will protect from unlimited loss. A sell-stop order is entered at a stop price below the current market price. Investors usually use a sell-stop order to limit a loss or to protect a profit on their investment. A stop-loss order can protect against subsequent decline in share price. You should know basic technical analysis which can show you levels of resistance and support for a stock. If you are holding stocks and prices going up, you want to lock your profit by placing a stop-loss order just under expected resistance line in case price come down. The advantage of a stop order is you don't have to monitor how a stock is performing on every minute or a daily basis. The disadvantage is that a stop price buy or sell order could be activated by a short-term fluctuation in a stock's price. The stop price is not the guaranteed execution price for a stop order. When the stop price is a trigger, the stop order become a market order. In a fast-moving market, stock prices can change rapidly. You need to be careful placing stop orders. Because of prices moving fast, your order might be executed much higher than stop price for buy stop order or much lower than sell stop price. Here is an example. If you place a buy order at stop price at $22.70, your order might be executed at any price above $22.70. If you place a sell stop loss order at stop price $23.50, your sell order might be executed any price below $23.50. Market fluctuations can activate a stop order, so a stop price should be selected carefully according to resistance and support level. For certain types of stocks, some brokerage firms have different standards for determining whether a stop price has been reached. Some brokerage firms use only last sale prices to trigger a stop order, while other firms use quotation prices. Investors should check with their brokerage firms to determine the specific rules that will apply to stop orders. By placing a stop limit order, you can avoid the risk of a stop order which is filled at an unexpected price, but the limit price may prevent the order from being executed out of your limit. A stop limit order is an order to buy or sell a stock that combines the features of a stop order and a limit order. Once the stop price is reached, a stop limit order becomes a limit order that will be executed at a specified price, or better. The benefit of a stop limit order is that you can control the price limit at which the order can be executed. You should consider the following. A stop limit order may not be executed if the stock's price moves away from the specified limit price, which may occur in a fast-moving market. Short-term market fluctuations in a stock's price can activate a stop limit order. The stop price and the limit price for a stop limit order do not have to be the same price. For example, a sell stop limit order with a stop price of $235 with a limit price of $230. This stop limit order become an active limit order if the stock price reached $235. However, the order could only be filled at a price of $230 or better. This is the way you control your executed price limit. When you place an order, you must choose time frame. Day orders, good till cancelled, GTC orders, and immediate or cancel orders. A day order means the order is good only during that trading day between 9:30 am to 4 p.m. Unless you specifies a time frame for the expiration of an order. Buy and sell orders are day orders. A good till cancelled GTC order is an order to buy or sell a stock that lasts until the order is completed or cancelled. Brokerage firms typically limit the length of time an investor can leave a GTC order open. This time frame may vary from broker to broker. Most brokers' time frame may be 180 days. Investors should contact their brokerage firms to determine what time limit would apply to GTC orders. An immediate or cancel order is an order to buy or sell a stock that must be executed immediately. Any portion of the order that cannot be filled immediately will be cancelled. Two other common special order types are fill or kill, FOK, and all or none, AON, orders. An FOK order is an order to buy or sell a stock that must be executed immediately in its entirety. Otherwise, the entire order will be cancelled. No partial execution of the order is allowed. An AON order is an order to buy or sell a stock that must be executed in its entirety, are not executed at all. However, unlike the FOK orders, AON orders that cannot be executed immediately remain active until they are executed or cancelled. Thank you for watching. Please subscribe my channel for future videos.